Hi everyone, this is Paul Stewart here from Segmented Solutions. I wanted to spend a bit of time on Budget Day explaining to you why it's still 0% tax on property investments. And this is a classic example where looking at a genuinely diverse exempt unit trust as an investment structure inside your SaaS is still exempt from tax. But how can that be? Because there have been a lot of tax increases in the budget. Well, this little video will explain, hopefully, why that is still the case. As we've seen in the budget, there have been tax increases right the way across the board, but in some cases they just don't apply. And there's a big difference between tax rate increases and statutory exemptions. And this little video is to talk you through that and how we're using statutory exemptions. And that allows you to have a property development business, a property rental business in the United Kingdom and pay no United Kingdom tax. So, first question I'm always asked, why on earth is this not some high-risk offshore tax avoidance? Well, it's not. It uses statutory arrangements and it's all onshore, so we're not using any clever offshore jurisdictions here. Everything here is UK-based. If you have a SaaS, that's UK-based. If you're investing in the genuinely diverse exempt unit trust, again, that's UK-based. So, let's have a little look at tax avoidance and statutory structures. With HMRC, there are different rates of taxes applied to different things. And when you start to look at tax planning, people look at tax saved. So moving you from a rate of 45% tax to a rate of 10% tax, that is a classic advantage that you're getting. It's a tax advantage. And the example there would be moving something from income, where it's taxed at, let's say, 45%, to a gain where it may be taxed at 10%. Having said that, there's been a lot of anti-avoidance provisions put in, and I want to stress here, we're not talking about tax evasion, which is illegal, such as hiding income. We're talking here about tax avoidance, which is open to HMRC rejection. And we're not involved in tax evasion, we're not involved in tax avoidance. We're actually looking at statutory tax exemptions. Give you a classic example. Investments inside pension schemes are exempt from tax. So if you have a SaaS, or indeed a QNUPS if you're offshore, but if you have a SaaS and you make an investment in that SaaS, any returns on that investment is tax exempt. And that is an exemption by statute. It's not any form of tax avoidance or tax evasion. Another example are unit trusts. The exempt unit trusts that issue units to pensions, they don't pay corporate tax on any of their profits that they make because the tax within a unit trust is levied upon the holder of the units. So if you've got an exempt unit trust holding sat inside a pension scheme, we've actually got two statutory exemptions working side by side. And that's why none of the budget increases in tax actually apply to the GDCV or the genuinely diverse exempt unit trust. So let's have a look. First of all, you have to start out with some form of pension scheme. And if you're a client of ours, that's traditionally a SaaS, self-administered pension scheme, and the SaaS purchases units in an exempt unit trust. Now, as you all know, a SaaS will be given a pension scheme's tax reference number, which basically says that it has been rubber stamped and is allowed to operate as a pension and therefore pay no tax on any growth or any income that is derived from its investments. If the SaaS were to then buy units in the genuinely diverse exempt unit trust, HMRC again give the unit trust a reference number, and under its regulations, it's allowed to operate and run as a unit trust and pay no corporate tax on any of the gains that it makes. So what you end up with is two exemptions working together where no UK tax applies. Obviously, if you're building up a big pot of money in your SaaS or a big pot of money in your QNUPS, there may be taxes applied when you come to withdraw that money, but we'll look at that a bit later on as well. So let's have a look at a unit trust investment. It's a statutory exemption within the unit trust, and if a unit trust is going to be buying property, there's nothing unusual with it putting a bunch of properties into limited company number 1 and more properties into limited company number 2 and 3 and 4 and so on. These limited companies perhaps own properties in different jurisdictions, as in maybe Manchester, Birmingham, Canterbury, different parts of the country, and they perhaps have different managers looking after them or different controllers in terms of the rental. But it's standard practice inside unit trusts to make use of separate limited companies for property holdings. So let's look at the taxation of the unit trust and the pension working together. We obviously start off with a pension, which buys units in the unit trust, and the unit trust has a limited company operating on its behalf, and that limited company buys a property. Now, the property will generate rent, or indeed it may generate profit, depends what's happening to the property, but that rent that comes in goes into the limited company, and the limited company, because it's operating on behalf of the unit trust, pays no corporate tax. So there's 0% corporation tax inside that limited company because everything happens inside the unit trust. They do what we call consolidated group accounts for all of their companies. And again, they're exempt. And this exemption is incredibly powerful. What it means is you can have one unit trust with multiple limited companies holding multiple properties, and none of those companies will pay corporate tax, and none of the property gains or indeed the rents will be subject to tax. And those units will grow because as value within the limited companies grows, the units grow, and all growth inside a pension scheme is exempt from tax. So here we have the classic pension, genuinely diverse exempt unit trust, limited company, property as an exempt structure with no UK tax to pay. Now, I put here taxation of SSASs and QNUPs because some people use QNUPs instead of SSASs. But if you're UK-based and you're using a SSAS, it's a UK pension, and you'll pay tax when you take your pension, maybe. Now, although a QNUPs is an offshore pension, if you don't have a SSAS and you're dealing with personal money, it's quite acceptable for you to use one of these, even if you're based in the UK. Now, the taxation of taking the money out of the SSAS or the QNUPs is driven by your tax residency at the time that you take the money. So it might be that during your working life, whilst you have young children, you live and work in the United Kingdom and you build up your pension pot using tax-exempt property investments. And then when you come to take that money, it might be that you decamp from the UK to become non-tax resident. And if you go to Dubai, for example, in the UAE, there's no tax to pay. So even with a UK pension, if you are not tax resident, you can still access money without any UK tax. So what you've ended up with is a structure where during the phase of growing your funds and growing your pension, there's no tax on the profits and proceeds, and you can do residential property as well as commercial property. And you can trade. You can buy a property with the specific purpose of converting it. So you can go from commercial to residential without having to exit. All of these things because you're using statutory exemptions and an exempt unit trust, which is allowed to buy residential property and is allowed to trade. So although it's budget day and there's been a great deal of changes to tax, none of those actually impact the statutory exemptions. And of course, some of you may be thinking, what about inheritance tax? And what about taxation on pension funds in the event of my demise? Well, again, if you were to look at a pension scheme, you can actually use all of that money and buy yourself an annuity. And there are many self-invested annuities in the marketplace. And some of those will actually pay out the sum of the annuity without inheritance tax. But that's for another video after the Chancellor has finished putting all the fine details onto the budget. So this is just a quick run through of tax exemptions versus changes in tax rates. And like I say, my name is Paul Stewart from Segmented Solutions. There's my direct dial landline number, which reaches me irrespective of where I am, and my email address. And the QR code and the My Smart business card link there will take you to all of the other videos that we do. Very happy to talk to you. I hope this was of some use. And I'd like to wish you all the very best in your business endeavours. Thank you very much for listening.